profit model, understanding how to run a profitable business. It's the path of money. So let's all be honest. What do? We have a goal of number of houses we want to sell every year, and then we set about selling houses and running to the bank with our commission checks. Selling houses and running to the bank with the commission check over and over and over and over again until we've reached our goal of units we've sold. And then we feel really great about ourselves until we start to break down the money. I made $70,000 this year. It didn't really feel like it. I wonder why. And then we start digging into the expenses. This agent realized they spent $21,000 of that $70,000 on expenses running his business. Now, what does that mean? How did you possibly spend $21,000 running the business? That's a 30% of your gross commission. And that is just about right for the average amount agents spend on running their businesses. Because what are your expenses? That's your office rent, your office bills, your CRMs, your IDXs, your MLS fees. If you paid for leads, that's in there. Your DORA fees, your realtor dues that we have to pay every single year. This is your meals when you were entertaining those clients. Sure, let me take you up to happy hour. Have another beer on me. That's your cell phone, the car, the gas, the mileage. That's your listing photography, your staging. That's your TC. That's all of your flyers. That's your signs, your lock boxes, the open house signs that I started the year with 30 and now I have 10. All of those are the expenses that racked up over the year of doing business, but allowed you to make $70,000 in gross commission. But when you pull that $21,000 out of $70,000, some simple math says the take-home income was $49,000, which, let's face it, is a lot different than $70,000. So the question is, how much did the agent make this year? Really, the agent made $49,000 this year. Who made the $70,000? The business did. And the business then paid its employee, the agent, $49,000. So he didn't make $70,000. He made $49,000 and is feeling like, no wonder I couldn't take a vacation. So how do we avoid this situation? How do we avoid thinking that we made 30% more than we did? We look at the math a little bit differently. So the first thing we want to look at is we want to look at the goal net adjusted income, your profit, your take home. Now, we often hear, I want to make $100,000. The clarifying question is, do you want the business to make $100,000 or do you want to take home $100,000? So this agent wants to take home $100,000. So that becomes the profit. That's what's paid to the employee. Percentage of expenses. Again, 30% is a great standard number. Now, if you've been in business for a number of years and you've been really good at tracking your expenses, you can go ahead and put in your actual percentage of expenses. For this example, we're going to use 30% because, again, it's about average for most real estate businesses. So doing some math, adding 30% in to 100 grand, we end up with $30,000 in expenses, meaning it's going to cost this agent $30,000 to make $100,000 to pay the employee. So the business has to be able to generate a gross commission revenue of $130,000 this year. So the agent, the employee in the business, can go ahead and take home $100,000. So if this agent wants to make $130,000 in gross commission revenue, how do they do that? So we do some more math. You look at your average sales price. We've used $400,000 here. Again, if you've been tracking your average sales price from last year, go ahead and plug in your actual average sales price. Average commission rate, 2.5. Now I want to give you all a word of caution on commission rates. Many people put in a larger number. They like to put in around 3. Why do people love to do that? Well, I always charge this, and this is my rates, and this is what this looks like. But when do we only get to set and control our commission? When we're doing listings. So unless you are only listing and you never vary from your commission rate, it's always better to err a little on the side of caution, right? Because if you lose one transaction, that can change a lot. Or if you have to discount for some reason a point or half a point, or you're working with buyers where you don't control your commission, you may end up showing a property that is not offering a commission that you're used to charging as a buyer's agent. So using a lower commission rate of 2.5% creates a bit of a cushion in there. Again, if you've been in business, you can go back and look at what your actual average commission charged has been for the previous year and use that number. So again, we do some math through here. The average commission dollar is $10,000. So on average, when you sell a home, your average commission check is $10,000. So in order for that gross commission revenue to hit 130, what do we need to do? We need to sell 13 units at an average sales price of $400,000 with an average commission rate of 2.5% for an average commission dollar of $10,000 in order to make that $130,000 gross commission revenue, spend 30% of it in expenses, all of those things we've listed out, in order for you to take home that $100,000. So next steps, fill out the Units to Reach Goals worksheet to find out how many units you need to sell in order to achieve your goals.